Welcome to the research desk. The central tension of this briefing is whether Meituan at HK 75.95, following an 83% collapse from its HK 460 peak, represents a late-phase capitulation opportunity or a structural value trap because Douyin has successfully moved the local services Tollbooth upstream to the attention layer.
I represent the opposing view, which is that, frankly, an 83% drawdown is not inherently a value indicator. It's just a number. My perspective is that Douyin's control over algorithmic discovery is fundamentally degrading Meituan's future earnings power.
Right, so we are going to test whether dominant internet franchises still deserve the benefit of the doubt when, user attention migrates. But first, let's look at slide 1 and establish the baseline metrics for this.
Yeah, let's get the numbers on the table.
Okay, so on March 13, 2026, Meituan trades at exactly HK $75.95. As I mentioned, that is an 83% collapse from its February 2021 peak of HK $460.
A massive, massive destruction of equity.
Completely. And it's sitting just above its 52-week low of HK $73.60. Yet, here's the paradox of value we have to address. It trades at a seemingly reasonable 12 to 15 times earnings multiple.
But see, that's exactly the trap. At HK $76, the stock is only cheap relative to a dead peak.
A dead peak?
Yes, a mathematically irrelevant peak. I mean, look, if Douyin has turned local services into a traffic toll booth, then anchoring to that historical high of HK $460 is just, well, it's the fastest way to lose capital.
You're saying the measurement has to be strictly against future earnings power?
Exactly. Because the market conditions that allowed for HK 460 valuation, zero interest rates, totally frictionless regulation, those are gone. If the structural reality is that Douyin intercepts the consumer at discovery, then Meituan is just a fulfillment utility now.
Well, let's transition to slide 2 then, because we have to connect this chart to actual operations. There is some common ground here, right? 3 unshakable facts bulls and bears have to accept.
Okay, I'm listening.
First, the extreme price damage. The stock is still slightly above its October 2022 trough of HK 52. So if we look at the narrative cycle clock, we are at, 4.00 to 5.00? Emotionally, we're in late phase 4, bordering the valley of despair.
Sure, emotionally. But the danger of the clock framework is assuming that a stock at 3.00, which is just a falling knife that looks exhausted, is actually at 5.00.
But the underlying business isn't a falling knife. That's the second fact. The reported business is not collapsing. I mean, in 2024, their profit nearly tripled.
Right, but...
And their core food delivery still holds roughly 65 to 70% market share. Plus, revenue growth remains a confirmed green gravity wall. That shows undeniable demand.
I'll grant you the top-line resilience, but you can't ignore the specific fundamental cautions flashing yellow right now.
The margins.
Yes, the margins are under severe subsidy war pressure. They're bleeding capital to defend that 65 to 70% share. And, capital efficiency is being actively strained by this overseas expansion. Plus, discount rates for Chinese equities remain highly uncertain.
Well, if you look at the extreme scan, it sits at 14 out of 20.
Which proves sentiment is washed out. It does not prove operations have bottomed.
But historically, an extreme scan of 14 out of 20 on a dominant Chinese platform is a massive signal. Let's look at the Tencent 2018 analogy to contextualize this.
I knew we'd get to Tencent.
Because it fits perfectly. So the setup. In 2018, the regulatory freeze hit. Game approval stopped entirely. Investors treated Tencent like its economic machine was permanently broken, right?
Right. Sentiment violently shifted.
Exactly. The stock fell sharply from invincibility to presumed permanent impairment. But the punchline is, Tencent restructured, they diversified, and they fully recovered. My point is that severe 80% drawdowns in these dominant platforms frequently become the most fertile entry points for sophisticated capital.
It's an interesting precedent, but, well, it's structurally flawed here. Not every 80% drawdown is Tencent 2018. Some are Yahoo in slow motion.
Yahoo in slow motion. We'll get to that analogy in a minute, but let's move to slide 3, because I want to lay out the affirmative bull case first.
Go ahead. Frame the asymmetry.
The market has overcapitalized what's wrong and completely undercapitalized what remains durable. Trading at 12 to 15 times PE with a triple 2024 profit, Meituan is being priced like a structurally impaired cyclical.
Because they issued a warning about sliding back into unprofitability.
Right, the 2025 loss guidance. But the market is ignoring the mass consumer habit, the logistics density, and the merchant integration. That 2025 loss guidance is not decay, it's infrastructure build-out.
I highly doubt the market is misinterpreting a return to losses.
They are, though. Meituan is defending domestic share, yes, but they're also building AI dispatch, and they are seeding overseas markets. I mean, look at the key to brand expansion. Hong Kong, Kuwait, Saudi Arabia, and now they're even testing in the US.
Which is incredibly capital intensive.
True, but it's investment, not impairment. Think about the Netflix 2022 analogy.
Ah, right. The streaming collapse.
Exactly. The setup. Netflix fell more than 70% from its peak in 2022. Subscriber growth stalled, competition from Disney and HBO spiked. The tension was that the market aggressively priced in terminal decline, assuming the whole streaming model was permanently broken.
Right, assuming it had just become commoditized media.
They didn't have to return to their old narrative. They just had to prove the market's direst assumptions were mathematically wrong.
And you think Meituan at HK76 is the same setup?
Exactly the same setup. Furthermore, food delivery is not pure media arbitrage. Douyin might own the attention layer, but Meituan owns the hyperlocal operational system. The rider density, dispatch efficiency, route optimization.
Renting traffic is easy, sure.
Right, renting traffic is a software feature. Reliable hyperlocal execution is an enduring physical moat.
Okay, let's move to slide 4, because I have to systematically dismantle this enduring moat premise. Let's attack the core intellectual trap here.
Which is what?
Bargain hunting. An 83% drawdown is not evidence of an opportunity. As I said, valuation must anchor strictly to future earnings. And if you look at that 2025 loss guidance, you cannot frame that as post-battle infrastructure building.
I'm arguing it's mid-battle fortification.
It means they are mid-battle, yes. Which means in the clock framework, Meituan is probably at 3.00. It's a falling knife that merely looks exhausted, not a 5.00 bottom.
But Douyin is just spending promotional dollars. It's a temporary coupon war.
No, that is fundamentally misreading Douyin. Douyin is not a competitor spending coupons. It is a completely different architectural platform that controls algorithmic discovery. They are taxing the funnel upstream.
But they still have to fulfill the order.
It doesn't matter. If they tax the discovery, it's a structural threat to the local services Tollbooth. Just look at the Pinduoduo versus Alibaba precedent from 2018 to 2023.
Alibaba had massive logistics scale?
Exactly. Alibaba had scale. They had merchant ecosystems, deeply entrenched habits. But PDD changed the discovery model and the value proposition.
Alibaba survived.
Survived, yes. But their margin profile and their multiple suffered permanent compression because control of user behavior shifted.
But e-commerce logistics is multi-day. Point-to-point hot food delivery is sub 30 minutes. It's different.
The time frame doesn't protect the margin. Spending to stop domestic local services leakage isn't creating some high-margin engine like Amazon AWS. It's forced defense. It just slows the deterioration.
And you think the Kita expansion is what? A distraction?
It's severe implementation risk. Pushing Kita into structurally different labor markets like the US and Saudi Arabia, add the China discount for geopolitics, and that 12 to 15 times multiple is just a rational clearing price. This is Yahoo in slow motion.
Right, you mentioned this earlier. Lay out the setup for the Yahoo analogy.
So, early 2000s. Yahoo had a massive user base, an incredibly strong brand, and they looked way too established to fail. They owned the homepage of the internet.
The tension being that search evolved?
Yes. Google captured search intent, and Facebook captured social attention. The punchline is that Yahoo remained relevant for a long time. People still used Yahoo Mail, but the stock bled continuously. The economic center of gravity just moved elsewhere in the value chain.
You're saying Douyin is Google in this scenario?
If Douyin becomes the default discovery engine for local consumption, Meituan risks that exact slow-motion irrelevance. They become the dumb pipes of hot food.
Well, let's synthesize these frameworks on slides 5 and 6, because this is where the debate gets really granular. It all hinges on whether Meituan is building infrastructure like high-speed rail with undeniable embedded utility, or if they're funding urban sprawl.
Urban sprawl being an economically unsustainable subsidized map. Exactly.
And the hidden fulcrum here, the absolute key to this whole debate, is segment-level contribution margins.
Yes, thank you. Finally, the actual metrics.
Our entire thesis rests on identifying which specific segment still earns excess returns after all costs, the rider pay, merchant incentives, and crucial traffic acquisition are fully loaded.
But platforms frequently obfuscate this. They blur the line between growth spend and maintenance spend.
If domestic core food delivery throws off robust cash, and the losses are strictly in AI and overseas optionality, then the multiple is fundamentally mispriced. It's too cheap.
Right, if. But if Douyin is forcing permanent maintenance spend domestically just to retain users, the multiple is a trap. It's the Pets.com parallel all over again.
From the .com era?
Yes. The Pets.com critique wasn't about whether pet food demand existed or if people knew the brand. The Super Bowl ads prove they did.
The issue was fulfillment costs.
Exactly. The issue was whether unit economics functioned when shipping heavy bags of dog food and fulfillment were honestly counted. Until full cost allocation is transparent at Meituan, the market's confusion is entirely rational.
Okay, so moving to slide 7. Emotionally in the valley, operationally in the trenches. The synthesis here is that both pure bull and pure bear extreme positions fail.
Agreed. It's not a clear zero, but it's not a screaming buy either.
Right. Meituan screens as washed out, but the gravity walls are mixed. We're looking at 1 green wall and 3 yellow walls, so the accurate label is strictly show me.
Show me the exact milestones, though. I have explicit data requirements for a reversal call.
Let's hear them.
2 consecutive quarters of improving gross margins in the core local services business, and concurrently, definitive evidence that Douyin share gains are decelerating. Without both, it's just a dead cat bounce.
So the mechanics of that reversal, how we actually see it play out, is best mapped to the Uber 2020 to 2023 analogy.
Ah, the pivot to profitability?
Exactly. Uber spent years trapped between being this indispensable urban mobility platform and a structurally unprofitable subsidy machine.
Burning billions.
Wasn't about sentiment naturally getting darker and exhausting sellers. It was about mathematical proof that forced investors to re-underwrite the franchise.
Which led to a massive multiple re-rating.
Right. Meituan requires better proof, not a better story. If they show that proof, the re-rating will be violent.
Sure, but Uber's competitors ran out of cash. ByteDance, Douyin's parent, has infinite free cash flow from short video. They don't have to relent. But let's move to slide 8, what this means for your portfolio.
We need to translate this intellectual debate into strict capital allocation directives.
Let's set the rules of engagement.
Okay, so Meituan is a watchlist core. It is not conviction core. At HK 75.95, a small 1 to 2% starter position is defensible. You average in over 12 to 18 months. Staged accumulation is preferred over a one-shot entry, targeting specifically near that HK 73.60 52-week low.
And I will dictate the absolute risk triggers here. You reduce or abort exposure entirely if active users or transaction volumes decline for 2 consecutive quarters despite elevated promotions.
Because that means the subsidies are failing.
Exactly. Also, if food delivery share decisively falls below 60% for 2 consecutive quarters, you're out. The moat is breached.
What about the international expansion?
You have to value that optionality at 0. The domestic business must justify the valuation completely alone. Treat Kita and Hong Kong, Kuwait, Saudi Arabia, and the US purely as free or low confidence optionality.
Fair enough. But let's look at the upside, re-rating mechanics. If Meituan demonstrates core margin stabilization meeting your criteria, and they show contained Douyin encroachment, you have to move aggressively.
From a 1 to 2% starter to what?
To a 3 to 5% growth allocation. That is totally justified given the extreme negative 83% sentiment baseline. The convexity is huge there.
Assuming the macro environment allows for it.
Well, yes. Diversified China internet exposure should remain market weight to slightly underweight until the domestic risk premia clarifies.
It always comes back to the macro discount.
So, to deliver the bottom line summary for this briefing, Meituan at HK76 says it's cheap enough to be interesting but not clean enough to be obvious.
It has the emotional signature of late-stage capitulation, but the valuation of a structurally damaged franchise.
The posture requires disciplined patience, not devotion or disbelief. You have to wait for the math to clear.
You can't just blindly buy the dip.
Exactly. The real question is not whether Meituan is down 83%, it is whether local services has become a traffic tax business.
This is the Research Desk, officially signing off.